Okay, good evening, guys. So today I will facilitate our class. Today I will facilitate our class, and today we are going to discuss one of a very important topic in advanced financial reporting, and that is employee benefits. We are going to discuss a very important topic in advanced financial reporting, and that is employee benefits. So under employee benefits is under IAS19. Employee benefit is under IAS19. Employee benefits is under IAS19. So what are employee benefits? If I may ask, what are employee benefits? So employee benefits are all forms of considerations. These are all forms of considerations given by an entity to an employee. Any form of consideration given by an entity to an employee. And we have examples. What are some of the considerations that employee can get from an entity? Maybe we can talk of salaries. Number two, we can talk of something like wages. We can talk of commissions. We can talk of allowances. We can talk of bonuses and etc. So all these are categorized under employee benefits. Any form of consideration that an employee gets from an entity. And then under IAS19, employee benefits are categorized into three main types. So types of employee benefits. Number one, we have short-term employee benefits. We have short-term employee benefits. Number two, we have termination benefits. Number two, we have termination benefits. Number three, we have post-employment. We have post-employment benefits. So post-employment benefits are also referred to as retirement benefits. They're also referred to as retirement benefits. And we can also call them as pensions. We can also refer to these as pensions. So now let's understand the three. What are short-term employee benefits? What are termination benefits? And what are post-employment or retirement or pension benefits? So short-term employee benefits, these are benefits that are payable within 12 months. These are benefits payable within 12 months. These are benefits payable within 12 months. And 12 months, we talk of one financial year. So these are benefits payable within one financial year. We have examples like salaries and wages. We have examples like salaries and wages. We have commissions. We have bonuses. We have allowances and etc. So benefits payable within one financial year. Then when we come to termination benefits, what are termination benefits? So termination benefits, these are benefits paid upon the termination of the employee contract. These are benefits paid upon the termination of employee benefits. These are benefits payable upon termination of employee benefits. So how can employee contract be terminated? An employee contract can be terminated by number one, an employee can decide to resign and therefore terminating their contract with an organization. And then this can also be terminated by the employer. So when an employee contract has been terminated by either the employee himself or the employer, the benefits that this employee gets upon termination of this contract are classified under termination benefits. Are classified under termination what? Are classified under termination benefits. Then lastly, we have the post-employment benefits or retirement benefits. So what are post-employment benefits or retirement benefits? Some people will call them pensions. By the way, here's one area that I want us to at least concentrate on because the two are very direct. So post-employment benefits, these are benefits that are paid upon retirement. So number one, we are noting that these benefits are paid upon retirement. These benefits are paid upon retirement. And number two, we should also note that these benefits, for these benefits to be paid, there is always an arrangement. So there's an arrangement between the employee and the employer. There is an arrangement between the employee and the employer. There is an arrangement between the employee and the employer. And therefore, this arrangement brings us to two types of post-employment benefits. Two types of post-employment benefits. Defined contribution plans. Defined contribution plans. Defined contribution plans. Defined contribution. And then number two, the amount payable, the amount payable is based on the contribution made by the employee and the employer. The amount payable is based on the amount contributed by the employee and the what? And the employer. Which means under this plan or under this arrangement, by the time the employee is working for an organization, there is an amount that the employee is contributing to this plan, and at the same time there is an amount that the employer is also contributing for the employee to this plan. So upon retirement, the amount that employee will receive will be the amount contributed by the employer added to the amount contributed by the employee. And that is what we refer to defined contribution what? Defined contribution plan. That is what we refer to defined contribution plans. There is another thing that we should not hear. There's another thing that we should not hear. That upon retirement, when now the final payment, when now the actual payment is made, the employee will bear the uncertainty. The employee bears the uncertainty. What do we mean by this point? The employee bearing the uncertainty. What do we mean by this point? The employee bearing the uncertainty. If I assume I work for an organization for 10 years, During these 10 years, I contribute to my defined contribution plan. I contribute a total of 2 million shillings. And then my employer contributes, let me say, another 2 million. And therefore, the total contribution made by myself and my employer sums to 4 million. Do you think at the end of the 10 years I will receive this 4 million? Of course, no. I will receive the 4 million. And then plus the what? Plus the interest. And this is what I mean by the employee bears the what? The employee bears the uncertainty, which means once the employer contributes, all the uncertainty are left for the employee. So that is what we refer to defined contribution what? Defined contribution plan. Our number two was defined benefit plan. Defined benefit plan. Defined benefit plans. So under this arrangement, the first thing that you need to note The benefit is paid. The benefit is paid upon retirement. That is the first thing that we need to note. The benefit is paid upon retirement. And then the pension or the benefit payable under this arrangement is dependent on either the average salary or the final salary. So the benefit payable does not depend, in this case, it does not depend by the amount the employee and the employer is contributing. But in this case, it depends on either the average salary, either the average salary or the final what? Or the final salary. Or the final salary. Which means in this arrangement, the employee is not contributing anything. Under defined benefit plan, the employee is not doing what? The employee is not contributing. The employee is not contributing anything. For example, we can say your average salary over your lifetime. Let me say your average salary over your lifetime sums to around 3 million. So your organization, by the time you are going home, they can decide to give you a percentage of this what? A percentage of this amount as a what? As part of your what? As part of your pension. As part of your pension. So as they calculate your pension under defined benefit plans, there are some assumptions that organizations always use. There are some assumptions that organizations usually use. So assumptions. So under assumptions, we have number one, demographic assumptions. Demographic assumptions. Demographic assumptions. So demographic assumptions are assumptions of things like the mortality rate. We can talk of mortality rate, the rate of employee turnover, how employees join and leave the organization, and maybe we can talk of the claim rate. How many people claim their pension by the time you're doing what? By the time you're making your claim. And then another assumption, we also have financial assumptions. We also have financial assumptions. We also have financial assumptions. So financial assumptions are things like the interest rates, the discount rates, the future salary benefits, and so on. Future salary benefits and so on. So guys, that brings us to an end of the introduction and also the foundation of this topic, employee benefits. So let us see one or two practical examples. From our past papers. Let us see one or two practical examples from our past papers. So you allow me, Ram. If you're in the WhatsApp, there is a question that has been shared. If you're in WhatsApp, there is a question that have been shared. If you're in your WhatsApp, there's a question that have been shared. It is 2015 question 4A. 2015 question 4A. Question 4A. Question 4A. So you are told Volta Limited operates a defined retirement benefit plan for its employees. On 1st January 2014, the fair value or maybe some are not in the WhatsApp, so let me share my screen. So you're told Volta Limited operates a defined retirement benefit plan for its employees. On 1st January 2014, the fair value of the pension plan assets was 2,600,000, and the present value plan liabilities were 2,900,000. Then the actually estimated and current and past service cost, the actually estimated current and past service cost for the year ended 31st December 2014 as 450,000 and 90,000 respectively. The past service cost is caused by an improvement in the pension benefits commencing 31st December 2014. The pension plan paid 240,000 on 31st December 2014, and on the same date, Volta Limited paid 730,000 in contributions to the plan. Interest rate on high quality corporate bonds for the year was 8%. Interest rate for high quality corporate bonds for the year was what? Was 8%. As at the year end, fair value of pension plan assets was 3,400,000, and the present value plan liabilities were 3,500,000. In accordance with the year 2011 revision to IAS19 employee benefits, Volta Limited recognizes measurement of gains and losses in other comprehensive incomes in the period they occur. And then we have the required. Calculate the measurement gains or losses on pension plan asset and liabilities that will be included in the comprehensive income statement for the year ended 31st December 2014. For the year ended 31st December 2014. So the question is testing measurement The question is testing on measurement of plan assets and plan liabilities. The question is testing on the measurement of plan assets and plan plan liabilities. So before we tackle the question, let's mention something about measurement or measuring plan assets and plan liabilities. Let's touch something on measuring plan assets and plan liabilities. So what are defined plan assets and what are defined plan liabilities, and how do we treat them in the what in our income statement, and how do we treat them in our income statement? So number one, undefined plan asset. Undefined plan asset. This is always an what? This is an asset. And then defined plan liability is a what? Is a liability. Is a liability. Then defined plan liability is a what? Defined plan liability is a liability. So defined plan asset is measured as follows. Number one, we have the fair value. We have the fair value of the planned asset brought down. Fair value of plan brought down. Then we add contributions to the plan. Then you add contribution to the plan. Then you add returns on plan asset. Then you add returns. Add returns on plan assets. Add returns on plan assets. Then you less carrying amount. You less benefits paid. Less benefits paid. And what you get by all this becomes your carrying amount. What you get by all this becomes your carrying what? Becomes your carrying amount. Then this carrying amount, we need to compare it with the fair value balance carried down. We need to compare this with the fair value balance carried down. We need to compare this with the fair value balance carried down. We need to compare this with the fair value balance carried down. So the difference between your fair value balance carried down and your carrying amount becomes your actuarial gain or loss. Actuarial gain stroke losses. Becomes your actuarial gains stroke losses. The difference becomes your actuarial gains stroke what? Actuarial gains stroke losses. And this format is always standard. Any question that will test this is the what? This is the format. Any question that will test this is the format. So if you cannot understand this, you better cram. Then you can just what? You can just have your what? You can just have your values, and you get your what? And you get your answers. Let's see how we measure defined plan liability. Defined plan liability. How do we measure defined plan liability? So we take the present value of the obligation brought down. Present value of the obligation brought down. Then you add, we say we add the expenses. And the expenses in this case are the current and the past service costs. So you add the current service cost. You add present, you add past service costs. Then you less what we are subtracting is same. So we less the benefits what? We less the benefits paid. We less the benefits paid. And what you get after lessing the benefit paid also becomes your what? Becomes your carrying amount. Becomes your carrying amount. Becomes your carrying amount. Then this carrying amount, once you determine your carrying amount, you compare the carrying amount with the present value balance carried down. Compare this with present value balance carried down. And the difference becomes your actuarial gains stroke losses. The difference becomes your actuarial gain stroke losses. One thing you need to note. Under what instance do we talk of an actuarial gain? In measuring defined plan liability, and under which instance do we talk of the actuarial losses when measuring defined plan liability? And the same applies to the defined plan asset. Under which instance do we talk of an actuarial gain, and under which instance do we talk of an actuarial what? An actuarial loss. So let me start with defined plan assets. Let me start with defined plan assets. So if the fair value is higher than the carrying amount, then we talk of an actuarial gain. If the fair value is higher than the carrying amount, we talk of the actuarial what? We talk of the actuarial gain. If the carrying amount is higher than the fair value, we talk of actuarial what? we talk of actuarial loss. If the carrying amount is higher than the fair value, we talk of actuarial loss. Then when I come to define plan liability, if the present value of the liability is higher than the carrying amount, what does that imply? If the present value is higher than the carrying amount, we talk of an actuarial loss. But then when the carrying amount is higher than the present value, we talk of what? We talk of an actuarial what? We talk of an actuarial gain. Because a liability is a loss. So if your liability increases, you do what? You lose. But then if your liability decreases, you are gaining. So with this format, let's go back to our question. With this format, let's go back to our question. With this format, let's go back to our question. With this format, let's go back to our question. 1 minute, let me get the question. All right, question 4A. So you're told Volta Limited operates a defined retirement plan for its employees. On 1st January 2014, the fair value of the plan assets, on 1st January 2014, the fair value of its plan assets were 2,600,000, and the present value of plan liabilities were 2,900,000. So this 1st January 2014, if this 1st January 2014, which means this is the beginning of the year, which means as at the beginning of the year, our fair value of plan assets brought down was what? Our fair value of plan assets brought down was 2,600,000. I will have 2,600,000. So maybe I can have it in, I can have my values in thousands. So 2,600,000. And that of our plan liability, was 2,900,000. 2,900,000. And then you are told the actually estimated current and past service costs for the year ended 31st December 2014 as 450,000 and 90,000. So our current and past service costs are 450 and 90,000. So we have 450, and then we have 90,000. We have 450 and 90,000. Then you are told the pension plan paid 240,000. The pension plan paid 240,000 on 31st December 2014. On 31st December 2014. And on the same date, Volta Limited, and on the same date, Volta Limited paid 730,000. So on this date, the pension plan is paying 240,000 as Volta Limited pays 700 what? Pays 730,000. So the amount paid by Volta Limited, is the contribution that the Volta as a company is paying to the what? Is paying to the plan. The amount paid by Volta Limited, that is 730,000, is the contribution this company is making to the what? Is making to the plan. So I will have my 730. And then you're also told that the pension plan paid 240,000. So 240,000 becomes our benefits paid because we are receiving this from what? From the pension plan. So I will have benefits paid. I will have 240. It was a minus. And then benefits paid. I will have 240. 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 Then you're also told the interest rate on high quality corporate bonds for the year was 8%. The interest rate for high quality corporate bonds for the year was 8%. So there was an interest. There was a what? There was an interest. So we have, this is the fair value of our what? This is the fair value of our plan assets. This is the fair value of our plan assets. And then out of this fair value, we are simply told that we received some interest. We received some interest of 8%. So interest are returns on our what? On our investments. We get interest as returns on our investments. So our returns on the returns of our plan assets was paid at 8%. The returns of our what? The returns on our plan asset was paid at 8%. Therefore, our returns on plan assets becomes 8% of our fair value. That was 2,600,000. If I take 8%, of 2,600,000, 8% of 2,600,000, I get 208. I get 208. I get 208. And on the same note, under the liability, the interest was the same. If we have a liability and we are charged interest, this becomes our expense. And therefore I will add interest cost. And my interest cost is at the rate of 8%. My interest cost is at the rate of 8%, but 8% of the total obligation that we had. 8% of the total obligation that we had. So it will be 8% of 2,900,000. It will be 8% of 2,000,000. 8% of 2,900,000. 900,000. What is 8% of 2,900,000? What is 8% of 2,900,000? What's 8% of 2,900,000? Brings something like 232. 232. And what else? We're told as at the year end, the fair value of the pension plan asset was 3,400,000. The fair value of the plan asset was 3,400,000. The fair value of our plan asset at the end of the year was 3,400,000. So we have 3 million. We have 3,400,000. While that of plan liability was 3,500,000. The fair value of our plan liability was 3,500,000. The fair value of our plan liability was 3,500,000. So what we need to determine to get here, guys, what we need to determine here is number one, we need to get our carrying amount under defined plan asset and our carrying amount under defined plan liabilities. Then we get our actual gains or losses. So under our defined plan assets, our carrying amount, we will take this fair value of our plan asset brought down, that was 2,600,000. Then we add to the contributions to the plan, that is 730. Then we add the returns on our investments, that was 208. Then lastly, we less benefits that we did what? We less benefits that was paid. We less benefits that was paid. If you take 2,600 plus 730 plus 208 less 240, we have here 8. We have 9. And we have 32. We have 32. We have 3298. We have 3298. So how do we determine whether the difference is an actuarial loss or actuarial gain? So our fair value balance brought down was 3,400, which means by the time we were closing our books, at the year end, the fair value of this plan asset that we are taking to our next financial year was 3,500,000. But based on our calculations, our carrying amount was 298,000. What's the difference? If you take 3,400 minus 3,298, you get 102. So 102 becomes our actuarial gain. 102 becomes our actuarial what? 102 becomes our actuarial gain. Why gain? Because our defined plan asset is gaining what? Is gaining value. Our defined plan asset is gaining what? Is gaining value. Let's do the same to our defined plan liability. So we have our carrying amount. So how do you determine this carrying amount? We'll take present value of our obligation. Then we add the current service cost and the past service cost. and interests, then we less the benefits paid to get the what? To get the carrying amount. So we'll have our 2900 plus 450 plus 90 plus 232. If you less 240, if you less 240, 34, 32, 34, 32. And that becomes your carrying amount. That becomes your what? That becomes your carrying amount. So our carrying amount of our defined plan liability is 3432. But our present value of this obligation, our present value of this obligation is what? Is 3500. What is the difference? What is the difference? What is the difference? If you take 3500 minus 3432, if you take 3500 minus 3432, you get 68. You get 68. You get 68. So what are 68? 68 becomes our actuarial gain or our actuarial loss. So the carrying amount of our obligation, remember obligation is a liability. The carrying amount of our obligation is 3432. But then as we close our books, our present value that we are taking to the next financial year is 3500, which means our liability increased. And if our liability increased, we talk of actual what? We talk of actual loss. We talk of what? We talk of actual loss. We talk of actual loss. We talk of actual loss. Then back to the question. What was the question? Calculate the measurement gains or losses on the pension plan asset and liability that will be included in the comprehensive income for the year ended 31st December 2014. 31st December 2014. So this is what these people wanted. They wanted an actuarial gain of 102 under our defined plan asset, an actuarial loss of 68 under our plan asset what? Our plan asset liability. Sometimes you can be asked the net what? The net actuarial what? The net actuarial changes. So if you're asked the net actuarial changes, we have a gain of 102 actuarial changes. We have a gain of 102. So if we have a gain of 102, this is a positive. So we'll take our 102. That is a positive. And then we have a loss of what? We have a loss of 68. So we less 68. One or two, if you less 68, the net actuarial changes, you less the loss of 68 and net change of 34. And this 34 goes to the what? Goes to your income statement. Goes to your income statement under other incomes. Guys, I think that brings us to the end of today's session, and therefore I will take one or two questions if there is. Nice. I will assume that we don't have a question. So we have our classes running from next week. Interested to train with building future minds can for the same. Those who are interested to train with building future minds can take this opportunity and register for the same. We on the registration we allow a minimum of 1,000 shillings per session. We allow a minimum of 1,000 shillings per session before you are given links to join the classes. Before you are given links to join the classes. So our charges are standard. They are 4,000 shillings per unit, all the way from foundation to advanced, and then business data analytics goes for 10,000 shillings. Business data analytics goes for 10,000 shillings. So business data analytics goes for. If you're interested in contacting our team, you can reach out to BFM through 075907. Maybe I can have it here. You can reach out to BFM through 07 59 399 0759 399 820 820, or 0790 0790 27 9027 782. 0790 or 0790 27 2782. You can reach out to these contacts, and you will be guided how you can register with for the same. Another thing to note: BFM will always have a team that will always guide you if you have issues with exemptions, booking examination, changing examination centers, and so on. So you don't have to have issues with the custom. We'll have our secretariat that will be guiding you, the same. Otherwise, thank you very much, guys. Thank you for joining, and we appreciate. Looking forward to have the same in the coming week. Thank you, and you're free to exit.